Hello and welcome to a brand new show of Market Makers. On this edition of Market Makers, we'll be talking about the market run-up, what has led to this magnificent rally in benchmark indices, where are markets headed in the run-up to the election. Is this as good as it gets, or right now markets are really out of the claws of a deep, pit, so to speak. Naren, fantastic to have you back and thank you for joining us. Everyone is mesmerized. A lot of bulls are even rubbing their eyes and they are actually questioning then, is the screen right? A 10% rally from the recent lows, a 7-8% uptick in the bank nifty and a 2-3% jump in nifty. Everything has happened in a matter of just 15-17 days.
See, actually, you should look at what happened in early January in the world. Essentially, through 2018, the US Central Bank was tightening monetary policy and doing a quantitative tightening of $50 billion per month. I think in early January, the US Fed said that we are not going to increase rates. And at some point of time in the year, we will stop quantitative tightening. And historically, when dollar becomes an asset class which becomes weaker, the whole emerging markets get huge amount of oxygen, and that is the kind of situation we are in. If you look at the month earlier part of the year, actually the money went primarily to the markets which crashed in 2018, like China. And in India, that money came a bit delayed. It came slightly later. In fact, there was a period of time when India had underperformed China 10% this year. And the money started coming to India, albeit late, because of the fact that people were worried whether they should put money before elections, after elections. And that kind of a view was what foreigners were worried about. So I believe it's a lot to do with what has happened to the Fed and what the Fed has decided to do this year. And that is a factor which we always tend to miss because we look very, very narrow in our own country. But the reality is India rally is not just an India rally, it's an emerging market rally of fairly large proportions.
So how should one understand the current price action? Because if you're worried about elections, if you're worried about low earnings growth and rich valuations, then you are missing on participating. And if you're not participating, you are not creating wealth. How does one deal with this kind of a dilemma when there is an event risk and the valuation support is missing, yet markets they continue to go higher?
See, I think first of all, we are not in euphoria like 1 year back. I think market mood has been somewhere in between euphoria and I would say fear. And consequently, I think this worry that you're talking about hardly exists, because if you look at flows, local flows, they've been moderating. Bulk of the flows that are still happening up, SIP flows, which are very, very positive. You have a situation where earnings growth is going to improve largely thanks to banking, but nevertheless, banking is a very, very big part of free float of all indices. That the fact that banking earnings will go up is a very, very positive development. And it is not that earnings is at this point of time extremely expensive. They may not be cheap, but I don't think, I think earnings is at fair value for bulk of the market except a few mega caps. And barring those mega caps, I think markets are fairly valued, and with the PSU pack being cheap, and the rest of the market is at fair value, and a few 5 to 10 mega caps and 5 to 10 quality mid and small caps looking overvalued at this point of time. So I don't think we have to worry that we are in that extreme that we were in 1 year back, where you had euphoria, huge local flows, huge valuations of large and mid cap, and you had a very, very different environment at that point of time. Whereas now we are in a much more reasonable environment. So I don't think this worry that you have is a problem. The only thing I would say is not in equity market. It is in debt that people have been very, very cautious. at a time when I believe that they don't need to be so cautious, because valuations and debt reflected by the yield to maturity of many of the categories is so high that they ought to have been much, much more positive. But they've been very reluctant to invest in debt funds. And the beauty about debt funds is even past performance was good. And despite the past performance having been good in most of the funds, people have been very cautious in debt.
So why debt suddenly has got a bad name? Is it all about the event risk which markets were not able to see from IL&FS crisis and NBFC liquidity crunch?
No, I think clearly last year we had quite a lot of euphoria and quite a lot of positives. For example, most of the financial services companies were trading at extremely high valuation with the exception of banks. And so the situation then was very, very different from what it is today. And after the ILFS issue, a lot of derating happened. And after the derating, many of the sectors had become cheap. So I would say that, I don't think, people are thinking that they are in extreme optimism. I don't think people are in extreme optimism. Having said that, are equity valuations at the level that you can make mega money at this point of time? The answer is no. Equity valuations are at this point of time at a level from which you can only make reasonable experience, and which is why from our point of view we've been pushing all our categories like asset allocator, balanced advantage. These kind of categories is what we've been pushing, because and SIPs, primarily because markets are not cheap. Markets are not expensive. There is neither euphoria, there is neither fear. So I would say that you're exactly in the middle. When you're in the middle, you have to push these middle of the road categories like recommending asset allocation, recommending categories like balanced advantage, and recommending SIPs.
If I look at, Naren, the tone of the portfolios which you manage and what the tone of activity at your AMC has been, you are revisiting high dividend yield stocks and especially high dividend yield PSU stocks. What's the thought behind this?
Actually, PSUs got derated for 10 years, and frankly, at this point of time, I have a simple metric. Look for stocks which are at single digit trailing PE. Look for stocks which are at this 5% kind of dividend yields. And look for stocks which are not too leveraged. So if I look at this combination of high dividend yield, low trailing PE and not too leveraged, I got a number of PSU stocks, and that's the reason we are like massively overweight PSU stocks. I'm hoping that the new government which forms after 2019 May recognizes that most of the PSUs are deeply undervalued, and there are huge opportunities to re-rate them through effective management of the shareholding in the next 5 years. And I think the strategic value of many of these PSUs have been fantastic. And the other interesting thing which people have to remember is, if you go back 10, 12 years back, you had everyone entering sectors like power. And in those sectors, the capital allocation mistakes by the public sector power companies were much lower than the amount of capital misallocations done by the private sector power companies. So there are sectors like power where in the last 10 to 12 years, it is actually the public sector unit which has become stronger, because in those heady days of 2007, they did not make capital allocation mistakes, whereas many of the private sector companies entered into power purchase agreements which were extremely bad and very, very bad for earnings. And so I would say that, there have been, contrary to what people think, there have been PSUs which have actually done a much better job of capital allocation in the last 10 to 12 years, and they've got derated. And I believe that the government in the next 5 years will recognize that this derating can be reversed, and we will make money out of that.
But what about the legacy capital allocation problems, constant selling from government in terms of the disinvestment requirement? You don't think they will act as impediments for PSU stocks?
See, actually, if you look at how markets behave, so if there was a private bank which went and told people, I'm going to do, or a high valued NBFC comes and tells people, I'm going to do a issue, what happens is they get re-rated. So I'm a believer that, whenever, for example, Morgan Stanley pulls out a stock from their index or adds a stock to the index, those are all contrarian opportunities for me to either buy or sell. So for me, I would say that public sector disinvestment, if it makes sense and I feel that the shares are attractively valued, is actually an opportunity, because I am adding to my holding in a stock which is trading at single digit PE, very good dividend yield, and non-leveraged company operating in a big sector like power and many of the other infra spaces. So that's how I look at it. So I don't worry so much about it. And my past experience has been that when you have too much disinvestment in any area, I have never really worried about it. I've only worried when people come out with disinvestment or IPOs in an overvalued sector, then we worry about it. Otherwise, I've never worried about it.
In our last conversation, Naren, you hinted towards buying exporters. Was that call primarily based on global growth and weakness in rupee? And if yes, is it time to revisit that call because rupee has appreciated?
So actually, in between is when the call actually failed. What happened was, when we last spoke, oil was on an ascent. And if oil goes up, you had a situation where dollar rupee actually kept appreciating. Dollar kept going up against rupee, and that was a phenomenal period for exporters. But what happened after October, November is that oil crashed, and with oil crashing, you had rupee appreciating. So the entire tactical view which we had on exporters, when it first worked and then failed. And my belief is, with rupee having appreciated again significantly, I would say again we are at a time to consider, because you have a good combination of rupee having appreciated and oil again going up. And once that happens, you again move to a situation where exporters look interesting. Having said that, I feel that, the way oil has been moving, it causes more volatility to it. And the exporters are reasonably valued but not dirt cheap. So I think it requires more tactical handling than what I would have thought 6 months. At that point of time, everyone believed that oil will keep going up in August, September, and consequently we had that view. But I think it is more range bound now, oil. But I would still say I would be tactically pretty positive on exports at this point of time, given the fact that rupee has appreciated.
I wanted to come to telecom, but let me rephrase a completely different question on telecom. We know you like telecom and you own telecom stocks. Now, the word from the telecom industry is that the price hemorrhaging will not continue, but the price rise may not happen. Disruption is the name of the game, and that is happening. Does it make sense to really go against the tide and against the crowd, where we know that market prices may not fall, but market prices may not rise? Also, telecom companies have a lot of capex which could be called as planned capex, and which will always act as a millstone around their neck when it comes to their capital allocation.
Actually, every month we spend time thinking whether is telecom a value trap or not. And what it appears to me is that we have had one of the most disruptive changes in market share over a period in this sector, and that is the reason why it appears like a value trap. I believe if I look at the next 5 years and I look at how all of us behave, I think it's a sector where which is very core to India, and without telecom and IT, there is no India. And if you ask me. That's why really this debate on whether it's a value trap or not is clear in our mind. It's not a value trap. Having said that, is it going through turbulence due to market share shifts? The answer is yes, and we have to handle it. We are investors for the long term. We get long term money from our customers. So I think it's only the trader who has a big problem, and I don't think telecom is a value trap. I do agree the kind of capex that they have had to do is significant. But I have a principle that after 10 years of no return, if there is a sector where I can invest and I'm confident it's not a value trap, you'll make money. And that rule clearly applies for me for both telecom and metals and power. And I've seen that because in 2012, when we launched our US blue chip fund, people said 10 years no return in US, why should anyone invest in US? But the next 6 to 7 years have been fantastic. So I believe that, once people have seen a bear run or no returns for 10 years, people just give up that asset class or give up that sector. And I believe that, then the opportunity is much more in that, because you have all the marginal players in that sector out. You have most of the people saying this sector is not worth investing, and you make money. And on the other hand, I've seen that once you have 10 years of bull run, like for example, what happened in real estate in 2012-13, people went to the other extreme, felt that there is no other asset class which is required other than real estate, and they go wrong. So maybe in 2022-23, real estate will again be that asset class which after 10 years of no return, and if it happens at that point of time, will be a sector which again people need to invest in a big way. So I've seen that people don't have patience for 10 years. And that's the reason. So the important thing is to be extremely bullish in the 10th year. It is not extremely bullish in the second year or third year, but to be extremely bullish in the 10th year in a non-value trap industry is very important in my opinion.
That's a great point and an important learning for me as well. I mean, I must say that, Naren, every time I interact with you, I look forward to interaction because there's so much I get to learn from you. So before we wrap, Naren, you mentioned this entire 10-year effect. So mid and small cap stocks have already seen a big bull run, and we've only seen 1.5 years of bad patch for them. So is the party in mid and small caps over, and one should wait for another 8 years before the revival will start?
Every cycle doesn't need to take 10 years. That's one thing. It is just that if there is a cycle which takes 10 years, you should be very positive. Our view on mid and small caps have been they are extremely attractive from the point of view of being an SIP investment for the next 5 years. And I don't know whether this downward cycle lasts 1 year or 2 years, but what I could see from the last cycle, the market peaked out in mid and small caps in April 2016. And the market bottomed out in small cap in August 2013. That was 7 years and 3 months. So consequently, I'm thinking that today, if I look at it, the peak was January 2018. So I'm saying if you do an SIP for the next 5 years, even if this next cycle is 7 years, I think if you have, after the last installment of 5-year SIP also, I think in 1 year you'll make good money. That's my thesis at this point of time. Returns can come much faster. There is no requirement that every cycle has to be 10 years. If a cycle is 10 years, then you should invest very aggressively is all that I mentioned. But every cycle doesn't need to be 10 years. I believe that if you look at metals kind of sector, there is a 10-year cycle. There has been a 10-year cycle, but within a year, peak to bottom of every metal stock is 20, 30, 40% difference. So which means that even in a 10-year cycle, there are 30 to 40% returns sometimes which can happen during a year. And so that's why I believe that mid cap and small cap require systematic investing. And I believe that that's the way we've been actually pushing the sector in the last 4-5 months. And I don't think that there is any requirement that every cycle has to be for 10 years.
So closing comments, Naren, I'm not looking for a political answer from you, but what do you think markets are betting in from an election verdict? So you don't have to tell me who's going to be winning the election, but what do you think markets are betting on? And I think there are three scenarios: return of the current government, return of the current administration with outside majority, or change of government. So which scenario do you think markets currently are betting on?
So I think I can tell you market is betting that this entire positive attitude to financial savings, positive attitude to reform like GST, positive attitude to using technology to dispense administration in the form of mobile phone, Aadhaar, internet, is what the market is betting on. And I believe that that is what the market is betting on. And I don't think beyond that. I always believe that Mumbai fund managers cannot predict elections. London fund managers failed miserably in Brexit. New York fund managers failed miserably in predicting US elections. And Singapore fund managers did not predict Malaysian election. So I think we have to do our job, manage other people's money in the right way for them. We have to give as right a view as possible on markets as we know, and continue to manage other people's money in the way we manage our money, and that's all is our job. And if we continue doing that, the potential for the Indian mutual fund industry and ICICI mutual fund through super products and debt, SIP, equity, products like BAF, asset allocation products, etc., should help us manage more of public money in the right way. That's our goal, and we shouldn't get distracted from that. And we should continue to manage money carefully. And I think the fact that at the top of small caps, we were careful on small caps has given me a lot of happiness in the last 15 months. And the fact that we pushed strategies which were defensive to the extent that people thought we were bearish, that entire strategy worked out well, and that's what we are happy about.
Okay, so Naren, on a lighter side, before we wrap, you said Mumbai fund managers cannot predict elections. Did you say that on purpose because you're from Chennai?
No. I was born and brought up in Chennai, but 90% of fund managers are in Mumbai. So it's not that all US fund managers are in New York. So I meant financial center capital. But obviously, I don't think just because I think I consider myself a Mumbai fund manager at this point of time, although I hail from Chennai. And I don't think, I do believe that, fund managers want to think that they know everything. They don't know. We can't even predict markets exactly, but I think we can still run money in the best interest of the investors over the long term.
Okay, and always a pleasure to have you back. Such an engaging conversation, and certainly hope to interact much more with you going forward. Well, that's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show. That was S Naren of ICICI Prudential Mutual Fund on where he feels there is value in the market, and the messaging is very clear. You could have a middle of the road approach because right now the event and the valuations are such that you cannot be too bullish or too bearish.